Hi, this is Joe Elsasser, President and founder of Covisum, and also a practicing financial advisor, and welcome to another FinPlan Friday. Today's topic is a bit of a vocabulary lesson. We're going to talk about taxes, and we're going to talk about the difference between marginal tax rates, effective tax rates, and effective marginal tax rates. Three different concepts that are each used differently in financial planning. So the first is marginal tax rates. You've also referred to a marginal tax rate as a tax bracket. This is how most people talk about, and if you're reasonably familiar with taxes, think about taxes. It's the idea that as you have more income on your return, you're going to be taxed at a progressively higher rate, and that rate is your tax bracket. Now, conceptually, it would be nice if we could all just know that our income is going to fall into a 10 or a 12 or a 22% tax rate. But ultimately, if you take your total taxes and you divide that by your total gross income, you're never going to come out, or almost never going to come out, with a rate that even really resembles any of the bracket rates. And that brings us to our second concept, the concept of the effective tax rate. Now, in addition to this bracketed system, we also have a variety of different deductions. People get a standard deduction, or they have the ability to itemize on a Schedule A. And the effective tax rate is the total taxes you pay divided by the total gross income that comes into the household. Effectively, it's a measure of what is my blended rate once I account for the fact that I have a standard deduction, once I account for the fact that some of my income falls into a 10, some of my income falls into a 12% rate, and some of it maybe falls into a 22 or higher percent rate. When we blend all those tax rates, you'll often find that the total taxes you pay are dramatically less than the tax bracket you actually fall into. So effective tax rates are a useful measure when we're thinking over a lifetime, right? Your total lifetime assets minus your total lifetime effect or total lifetime taxes really gives you a lifetime effective tax rate. And that lifetime effective tax rate is useful in thinking about how much of my money do I actually own and how much of it is on loan from Uncle Sam. In other words, if I've saved mostly in 401ks and in IRAs, I've got a silent partner, Uncle Sam. It's the unpaid taxes that will be due when I withdraw the funds from those accounts. And so when I think about an effective tax rate, it's really important to think about that really over a lifetime, because it tells me how much of my money is my own. Now, the last one is the effective marginal tax rate. And the question for the effective marginal tax rate is, what happens on the next dollar that I withdraw from a certain account, or the next dollar of capital gain that I harvest? Now, of course, we have tax brackets for ordinary income and we have tax brackets for capital gains. But in the same way, you'll run into situations where the rate that you actually pay on your next dollar of withdrawal is totally different than any of the brackets. And here's a good example. Let's say that I'm right on the edge of the 12% heading into the 22% tax bracket, and I take an extra dollar out of my IRA. But let's also say that I have some capital gains that were falling into a 0% tax bracket. When I take that extra dollar out of my IRA, I'm pushing not only a dollar at 12% onto my return, I'm also pushing a dollar of capital gains out of a 0% capital gains bracket and into a 15% capital gains bracket. Realize the only thing I did was take an extra dollar out of my IRA. And technically I would fall into a 12% tax bracket, but I'm actually going to pay 27% in federal income tax on that withdrawal, because the combination of paying my 12% on my IRA withdrawal plus pushing a dollar of capital gains that would have come at a 0% rate into a 15% rate means I pay 27 cents in tax. And so when we're making financial planning decisions, the right way to think about taxes is this effective marginal rate. How much do I actually lose to Uncle Sam on my next action, on the next dollar I take from an IRA, or on the next dollar of capital gains I harvest? So those are really the three different tax concepts, you've got marginal tax rates, that's your bracket rate. And frankly, it's not a rate that you should pay a lot of attention to for making any financial planning decision. It's the easiest one to talk about, but it's the least valuable. The effective tax rate is how much of your money do you actually own and how much of it belongs to Uncle Sam? And it's really useful when thinking about the lifetime of the client. And the last is the effective marginal rate, and that's where the vast majority of financial planning decisions should be made. Thanks so much for joining us. We look forward to seeing you for the next FinPlan Friday.